Hello everyone, welcome to Audible Wisdom. Protect your eyes with your ears. I hope you enjoy listening to books.
The book we are going to discuss today is called Stop Loss. It's a book about how to minimize losses in our investments. Actually, the original title of the book is What I Really Learned When I Lost $1 Million. It's a very famous book, and it's considered a landmark book in the psychology of trading. It's one of the classic books that investors need to read. It was also one of the inspirations for Nassim Taleb's famous masterpiece, The Black Swan. It was hailed by Taleb himself as one of the rarest of investment books. It was published in 1994. It's been a bestseller in the US for years. It's won many business book awards. When we think about investing, most of us naturally think about how to make more money. How can we achieve that goal? There are really only two ways. The first is to learn from the successes of others so that you can make more money. The second is to examine the failures of others in order to reduce your own losses. I think most people will choose the first. That is, to learn from other people's successful investment experience. But this book will tell you, when it comes to investing money, most people actually choose the wrong method. To succeed in this investment game, the more important thing is not to learn from success. It's about learning from your failures. And the author of this book proves it to us from his own experience. What exactly does that mean? The author of this book is Jim Paul. He was Morgan Stanley's first vice president of international energy, a director and member of the executive committee of the Chicago Mercantile Exchange. He's been a futures trader for 25 years. He's been a retail trader, a futures trader, head researcher. Of course, it's okay if you don't know these terms. It just means this author became very successful from his personal experience. So, inevitably, this guy got a little cocky. Until one day he lost all his investments and his reputation was seriously damaged. How big was the loss? He lost $1 million in 75 days on a 15-year investment. After this failure, the author learned from his mistakes. He and another colleague wrote this book based on their personal experiences. Now, I'm going to divide this book into 3 parts for you. The first part is to tell you the author's story. I'll tell you why it's more important to learn from your failures than your successes in investing. In part 2, we'll talk about how small losses can turn into big, catastrophic losses. And in part 3, we'll talk about the solution, how to avoid falling into psychological traps and minimize losses. Let's start with part 1, which begins with the birth of this author. This author, Jim Paul, was born into an ordinary family in rural America. His family wasn't rich, and he knew from a very young age that money was important. He knew the only way to afford good things was to make money. At the age of 9, he got his first job caddying at a country golf club. And it was this experience that opened his eyes to the lives of the rich. Rich people who drove around in convertibles with pretty girls and chiffon headscarves and the best golf clubs. So what was the difference between these rich golfers and the caddies on the course? Well, the author realized that all these rich people had one thing in common. They were all educated, or at least had gone to college. And he also noticed that all high-paying jobs require an advanced degree. In other words, in order to make more money, you have to have a higher education. After realizing the rules of the game in the rich world, the author's goal was clear: to go to college. So he worked hard to earn money and studied hard at the same time, until he was accepted into a prestigious university. As he studied, he became more and more convinced that everything has its own rules. As long as I know what the rules are and follow them, I can do the things I need to do with the least amount of effort. I just do the things I have to do, and I can get a very good result. It's like a test. If you get a C, you pass, right? So this writer's grades are mostly C's. And so this author proved again and again that all successes can be duplicated. All I had to do was find the rules of the game. I just had to find the rules of the game behind the success and follow them, and then, as you can probably guess, the rest happened. Success after success made this author more and more confident. He began to feel that he was different from ordinary people. For example, he had never played a card game before. Just because he knew the rules of the game so well, he won enough money to pay for 7 semesters of tuition. This writer rarely attended classes. He just read a book the day before an exam and got an A. But none of his friends passed. And that's what made him more and more confident. He felt he could succeed at anything he did. After graduation, he entered officer training school. Again, he saw enlistment and officer training as a game, and he followed the rules of the game until the end of the program. He was an honor graduate. He went on to become an instructor at Aberdeen Proving Ground in Maryland, the first second lieutenant to become a chief instructor, and it was just a very smooth ride. Throughout this process of advancement, he continued to attract the attention of those around him. In particular, he was recognized by his commanding officer, and as a result, at the age of 23, Jim Paul had accomplished something extraordinary. What was that accomplishment? Well, just to give you an example, one of the central secrets of all armies at that time was the stockpiling of joint venture weapons. By the age of 23, Jim Paul had already mastered this top secret. You can imagine how much the entire military valued him. It's an experience that a lot of people probably wouldn't even think about. Jim Paul is certainly an accomplished man. And of course, that success reinforced his beliefs. He felt that he was different, that he was better than the rest. As we've said before, the goal of making money had been on his mind since he was a child. Didn't he go to college to make more money? But now he's in the army, and even though he's being promoted, his salary isn't very high. So you can probably guess what he did next. He decided to get out of the army. He chose to get out of the military and go back to college. And this time he wanted to major in a field that dealt specifically with money. He chose a master's degree in business administration. That's when Jim Paul decided to become a stockbroker. By the way, there was a little hiccup on the way to becoming a stockbroker. And this little episode convinced Jim Paul once again. If you know the rules of the game, you can do anything you want. What was it? Well, during his interview at the ID company, he was faced with a particularly difficult question. How difficult was it? We won't go into details, but the name of the test is the Minnesota Value Propensity Test. It's a very complicated test, but is there a shortcut? Well, Jim Paul looked for a shortcut, and it turns out that there is a shortcut. He found a book at the bookstore. It's called The Brain Observer. This book has a lot of information about this test, the theory behind it, the experimental data of brain science. Jim Paul studied the book very carefully, and he passed the Minnesota Value Propensity Test with flying colors and a very high score. Anyway, Jim Paul got the job with flying colors. With such a good start, Jim Paul was able to get into the stock market he had always dreamed of. His life was on the fast track, and his career was skyrocketing. Speaking of which, let's take a quick look back. In fact, all we've said. It's an inspiring story about a man who went from the bottom of the ladder all the way to the top. Of course, that is only the first half of the story. The real twist is about to happen. Just when this writer thinks he's reached the top of his game, his life takes a huge turn. The price of lumber on the market began to plummet. The volume of orders he was handling dropped by more than 80%. At the same time, other markets he was involved in, like soybeans, took a nosedive. And the next thing you know, he lost a full $1.5 million in less than 3 months. All the money he'd made in 15 years. He lost it all. Not only was his account liquidated by his brokerage firm, but all of his assets were seized. That meant that everything he had worked for all those years, he lost in that moment. All the wealth he had accumulated evaporated almost overnight. Remember what we talked about? Jim is a guy who's good at summarizing patterns. He thought, since his investment strategy failed, what now? Why don't we summarize the pattern? Why don't we look at what other people are doing and come up with a set of rules for success? The results were fantastic. What are the rules of investing? The answer is there are no rules. Everybody says different things. For example, the world's largest investor has an average growth rate of 15% over 31 years. The famous John Templeton once said, "Diversify your investments." That is, don't put all your eggs in one basket. But there is another stock trader who is also very powerful. He's almost as good as this guy, William O'Neill. He once said that diversification is just a form of risk aversion. Pay attention. Somebody says diversify, but then somebody else tells you not to diversify. There's more than one person who's said that. Like the great old man, Warren Buffett, who's known as the god of stocks. He said, "Concentrate your investments, don't diversify." You see, whether they tell you to diversify or to concentrate, all of these people, without exception, have been very successful. So who should you listen to? In other words, there's probably no hard and fast rule about how to make an investment work. So what should you do? Poole, the Nobel Prize-winning physicist, once said, "The opposite of a truth is a fallacy, but the opposite of a profound truth is probably another profound truth." That's actually kind of true. That's what Jim did at that point. He took a completely different perspective than he had before. Before, he'd summed up his successes. This time he turned it around and focused on the losses, the failures. And he made an amazing discovery. All the experts agreed on what they thought about losing money. In other words, learning from success doesn't necessarily make you successful. That's for sure. But the problems that lead to failure will lead to failure. That's a certainty. And since that's a certainty, why don't we take that certainty and look at what causes failure? One of the things that Jim Poole found interesting in reviewing these failures was that most failures are not caused by external circumstances. They're caused by something inside of us. In Part 2, we'll talk about how these psychological factors lead to investment failure. We all know that no matter what kind of business you're in, you're going to lose money. This is an objective fact, but it's one thing to know it and another to accept it. These people in the trading market always have a hard time recognizing losses because they tend to see losing money as a failure, an incompetence, or a mistake. At the same time, they see profits as success or as being right. In this book, the authors divide losses into two categories. The first is called external loss. This is something that exists, such as losing a game, losing a competition, losing money on an investment. This is also the meaning of our daily life. The other type of loss is called internal loss. What does that mean? It's about the psychological aspects of each of us. The more common ones, such as loss of self-control, loss of dignity, loss of sanity, are identified purely by our personal experience. For example, if you lose $100 on a stock, it's different for everyone. For some, it's just a meal, no pain, no gain, nothing to worry about. But for others, it could be a few days' food. It's a big loss, and they can't get over it. You see, this subjective emotional feeling is a subjective loss. When an external loss becomes an internal loss, that is, when the objective loss becomes a subjective loss, many people find it difficult to accept the results of their losses. Losses in the investment market often go through this transformation process. Losing money is just an objective loss. It's a normal thing. But you may have unconsciously brought in negative emotions. You think that losing money is a failure, a mistake. These internal losses often make emotional decisions. In the end, a small loss becomes a catastrophic loss that can't be recovered. So how do we prevent objective market losses from becoming internalized losses? Well, to solve this problem, we need to understand how this transformation actually occurs. The authors found that the process is very similar to the psychological process that occurs when a person faces death. He divided internal losses into 5 stages, based on the 5 psychological stages a patient goes through when he learns of his illness. Let's take a closer look. First, when the market is losing money, traders don't know what to do. It's like a terminally ill person who hears bad news and suddenly becomes helpless. Then they enter the first stage. This first stage is called denial. It's a stage where he denies that the market is getting worse and worse. The trend is still positive. It's still a profitable trade, and he can still make his bets. But he's afraid to sit down and figure out how much he's lost. Just as a patient who learns of a medical condition often denies the diagnosis at first, when they can no longer deny it, they enter a second phase. It's called anger. They may lash out at family members or curse the market. Just as some patients who have to accept the fact that they're sick develop resentment. They feel they've been given the disease, and then they project that anger onto the doctors, the nurses, or their family. And then the third stage is bargaining. The investor starts to compromise as long as the market is going up and the trade isn't losing money. He will close the trade as soon as the market goes up and the trade doesn't lose money. Like a sick person praying to the heavens for the inevitable. The patient prays to the heavens to delay the inevitable outcome as long as possible. Then we come to stage 4. The investor becomes more and more frustrated with the loss of money to the point of depression. They can't eat, They can't sleep. They can't even be interested in anything anymore. Finally, they have to face the inescapable reality that they have to get out. It's like a patient accepting the inevitable. In investing, this transformation of external losses into internal losses is more likely to happen than in a basketball game or a bet. Why is that? Well, if you think about it, you'll realize that events like basketball games and dice rolls have a definite point in time. When the game ends or the dice stop rolling, it's over. The damage caused by these individual events is also clear. The result is there. A loss is a loss, but investing is different. It's an ongoing process. Participants have to make decisions over and over again, and every decision they make will affect whether they make money or lose money. In this process, you don't know which way the future is going to go, when it's going to end. You can deny the loss, insist that the future will be profitable, and keep raising your bets. But this kind of emotional decision-making often leads to bigger and bigger losses. So what can you do to minimize your losses and prevent them from growing? It's simple. It's to avoid being controlled by emotions and making irrational decisions. At this point, we must mention the psychological myths that cause us to make irrational decisions. There are 6 in the book. I've chosen 3 of the most common ones to tell you more about. The first type of fog is called Monte Carlo fog. It's also known as the gambler's fallacy, a term you may have heard before. One of the first people to introduce it to the investment world was the author of this book, Jim Paul. The gambler's fallacy is the idea that people always want to believe that after a series of random events, the probability of the same event happening again is greatly reduced. That's pretty abstract. It's just that we tend to believe that after a series of successes, there must be a failure, and vice versa. After a series of failures, there must be a success waiting for us. But is this true? No, many things are random, independent events. That is, each process is random and independent of the other. For example, if you roll a dice, and the first time you roll a 1, it doesn't mean that the second time you roll it, it will be a 1. It doesn't mean that you are less likely to get a 1 on the second roll. You have exactly the same chance of getting another 1. And every time you roll the dice after that, you actually have the same chance of getting a 1. These are independent random events that have nothing to do with each other. This is the first type of mental fallacy, called the gambler's fallacy. The second mental fallacy is our optimistic expectations. We tend to think that the probability of something good happening is greater than the probability of something bad happening. Let's take an example. Which of the two is greater, winning the lottery or being struck by lightning? Many people would think that the odds of winning the lottery are greater. But in fact, the odds of winning the lottery and being struck by lightning are about the same, almost 1 in 10,000. The third mental fallacy is that we often underestimate the probability of small events. That is, the probability of an event is so small that we tend to think it will never happen. But note that a small probability is not the same as a 0 probability. Let's say you're playing poker and you realize you have all the spades in a deck. It's a rare event, but many people who play a lot of poker might actually have this happen to them. This is because the probability of getting all spades in a hand is the same. A small probability is not the same as a 0 probability, as I'm sure you understand. The way to minimize losses is to minimize the interference of these emotional factors. And all emotional reactions come from our fear of uncertainty. So the key is to find a way to live with uncertainty. Now, in part 3, we'll talk about these approaches. There are 3 ways to deal with the risk of uncertainty. The first is the engineering approach. You can imagine the work of an engineer. They're always trying to find the best answer to a problem. So the engineering approach is to control the variables that affect the outcome as much as possible. The second is called the gambling approach. This approach is the opposite of the engineering approach. It's pure chance. It's looking at the future as a gamble. Of course, both approaches seem a bit extreme. The former requires too much analytical skill, while the latter simply abandons analysis and takes its chances. The third method is called speculation. It's somewhere in between. Note that speculation is a technically neutral term, in no way derogatory. It is characterized by neither relying on scientific laws to predict the future, nor being ignorant of future outcomes. It will rationalize and systematically analyze an uncertain future. and speculation more or less leads to successful investing, successful trading, successful arbitrage. Let's focus on the speculative method. How does the speculative approach work? It requires you to plan ahead. Before you act, you must rationally decide whether or not to make a particular trade, when to buy and when to sell. To put it bluntly, you can't control the whole game, but you can control when to get in and when to get out. And it's important to get it right as soon as possible. You'll also find that this game you're playing with the market can't be completely fair. Why is that? Because the market is a system and you're just one individual. So how do you win this game? It requires that you stop facing the market as an individual. Instead, you have to upgrade yourself as much as you can and build yourself into a stable system, and then play the market. What do you mean, upgrade yourself into a system? You can imagine the question. Why a player can't win in a casino? Actually, it's very simple. It's two systems. The player is a system of experience and a system of luck, i.e., everything depends on chance. What is a casino? It's a data system with scientific mathematics behind every step. That's why a player can never win in a casino. So how do you win? You have to turn yourself into a data system with clear steps, and then follow them with determination. It's the same in the investment market. You have to have a set of principles, and then you have to say to yourself, no matter what happens, I'm going to stick to these principles, and I'm not going to change them at all. For example, the founder of the largest hedge fund in the world, Bridgewater, the famous riddle in Rio. In his book, Principles, he says, you have to think about your decision-making principles, and then write them down and implement them. And you need to establish those principles before you go to market. It's a good idea to write down a plan based on those principles, and then whatever happens, don't change it. For example, you need to determine what your investment goals are in the market, how much money you want to make, what kind of things you want to invest in, whether it's stocks and bonds or forex futures, how much money you're willing to lose before you walk away. These questions should be answered before you invest. We have just said so much, but it can be summed up in one sentence. That is, to minimize losses, you have to plan ahead. You have to anticipate what you're going to do if something happens, and pay attention. When those things happen, you have to follow the principles that you've laid out in advance. And that's about all we have to say about the main points of this book, Stop Loss. Let's review. We've answered 3 questions today. First, from the author's real-life experience. We said that it's just as important to learn from failure as it is to learn from success, because the successes don't always lead to success, but the problems that lead to failure do. Then we talked about how small losses can turn into catastrophic losses. We analyzed the 5 stages of external losses that turn into internal losses, and the 3 key psychological mistakes. Finally, we talked about the solution to minimize losses. That is, to establish principles in advance and to avoid impulsive behavior. After all that, what's the biggest message of this book? We can borrow from Daniel Kahneman's book, Think Fast and Slow, where he mentioned a theory that the human brain is actually divided into 2 systems. One is the fast system, which is dominated by emotional intuition, and the other is the slow system, which is dominated by rational analysis. The key to successful investing is to allow the slow system to make as many decisions as possible, so that the fast system doesn't take over the slow system. Even deeper, the biggest lesson of this book is that we're too used to looking at the big picture from an individual's perspective. In investing, for example, each person is an individual, but the investment market is a huge, complex system made up of countless individuals. Well, that's all for today. Congratulations on finishing another book. Thank you for your support and interest. Please subscribe to the Audible Wisdom channel, like it, and share this valuable knowledge with your friends, so that together we can combine wisdom with practice and realize our financial goals and create a better life. Thank you. See you next time.